When it comes to investing, there are a few topics that get people as fired up as dividends. Seriously, it's a debate that splits investors into these really passionate and often completely opposite camps. So today, we're going to cut through all that noise and just look at what decades of data really say about building wealth with dividends. So on one side, you've got the dividend devotees. Their whole philosophy is simple and, honestly, pretty powerful. Build a portfolio that pays you enough in dividends to live on, so you never ever have to sell a single share. But then, on the completely other side of the ring, you have the total return advocates. These folks argue that focusing on dividends at all is just a distraction. For them, the only thing that matters is the overall growth of the portfolio. Doesn't matter if it comes from dividends or a rising stock price. So who's actually right here? Is one side completely wrong? Or is the truth, like it so often is, somewhere there in the middle? All right, let's dive in and figure this out. And we're going to start with the absolute basics. Before we can even begin to talk about strategy, we have to get one thing crystal clear: what a dividend actually is. Because honestly, a lot of this huge debate comes from a pretty fundamental misunderstanding of the mechanics. Okay, let's get this out of the way right now. A dividend is not free money. I know, it really feels like it when that cash just magically appears in your account. But no new wealth is actually being created. Think of it more like a transfer of value. Cash is just moving from the company's bank account directly into your pocket. Let's make this super clear with a simple example. Imagine you own one single share of a stock, and right now it's trading for $100. Pretty simple, right? The total value of your holding is, of course, $100. Okay, now the company decides to pay out a $2 dividend. Here's the part that trips people up. On the day that happens, the stock price will automatically drop by that exact same amount. So now you have one share of stock that's worth $98, plus you have $2 of cold, hard cash in your hand. Your total value? Still exactly $100. Your net worth hasn't changed one bit. It's just been rearranged. And this is just such a great way to think about it. From a purely mathematical standpoint, getting a dividend is identical to just selling a tiny piece of your stock. I mean, think about it. In both cases, cash comes out of your portfolio and the value of your stock holding goes down by that exact amount. They might feel totally different emotionally, but financially, they are twins. So if dividends aren't just free money, then why do we care so much about them? Well, their role in the market has actually changed dramatically over time, which means your strategy has to adapt right along with it as you move through life. Let's just look at the big picture for a second. Get this. From 1940 all the way to today, dividends have been responsible for about 34%, that's roughly 1/3, of the S&P 500's total return. That is a massive chunk of the market's historical growth. But, and this is the crucial point that so many people miss, that 34% number only works if you reinvested every single dividend you ever got. The real magic isn't just in getting the cash, it's using that cash to buy more shares, which then pay their own dividends, creating this incredibly powerful compounding snowball. The moment you spend the dividends, you break that beautiful compounding engine. And this really highlights how much the market has changed. I mean, back in our grandparents' era, the average dividend yield of the S&P 500 was pretty consistently around 4%. Today, it's way down, closer to 1.5%. This is mostly because of the rise of huge tech giants that plow profits back into growth, and this big corporate shift toward using share buybacks. The takeaway is pretty clear. You just can't rely on the same level of income from the broad market that past generations could. So what does this mean for you? It means your approach has to evolve over time. When you're in your 20s, the goal should be pure, unadulterated growth. You should be reinvesting every single dividend. As you move into your 30s and 40s, you're still focused on growth, but maybe dividends start adding a nice layer of stability. It's really not until your 50s and beyond that dividends begin to shift from being a growth engine into a true income tool. And even then, it's just one part of a much bigger plan. And that brings us to the ultimate stress test for any dividend strategy: funding your retirement. This right here is where the debate gets the most intense. And you can't deny the emotional appeal. The idea of living off the fruit of your portfolio, the dividends, without ever having to touch the tree, your original shares, it's just incredibly comforting. It feels so sustainable and safe. And for a lot of people, that psychological benefit is absolutely huge. But let's look at the actual math. Say you wanted to generate $35,000 a year in income from a high-yield dividend ETF like VYM. With its 2.4% yield, you'd need a portfolio of about $1.46 million. Now, in contrast, using a pretty standard 4.7% withdrawal rate from a total return portfolio, you'd only need about $745,000. That is almost half as much. This just goes to show that psychological comfort can come at a very, very real cost: mathematical efficiency. Okay, here's another area that causes a ton of confusion: required minimum distributions, or RMDs. A lot of people think that if their IRA just generates enough in dividends, they've satisfied their RMD for the year. But that's just not true. A dividend that's paid inside your IRA does not count towards your RMD, even if it's just sitting there as cash. The only money that counts is money that physically leaves the account and gets transferred to your bank account. So if a dividend-only plan is pretty inefficient, and a dividends don't matter at all approach ignores the reality of how we behave as investors, what's the answer? Well, it's all about finding a smart, practical balance. And let's be totally clear, dividends have some real strengths. I mean, for investors in lower tax brackets, qualified dividends can be extremely tax efficient. They also provide these powerful behavioral guardrails. Just seeing that income roll in can be the thing that helps you stay invested during a scary downturn. And a lot of good dividend funds naturally screen for high-quality, profitable companies. But focusing only on dividends has some serious risks. Chasing those super high yields, that often leads you right to financially stressed companies that are about to cut their dividend. You can also become dangerously concentrated in just a few sectors, like utilities or energy. And maybe most important of all, it creates a really rigid plan where you can't adapt your income to your actual life needs. And this all leads us to the solution, what we call the total return framework. It's a much more flexible, holistic strategy where you don't rely on just one source of income. Instead, you meet your spending needs by using a sustainable combination of everything your portfolio generates: your dividends, any interest, and planned strategic sales of your assets. So what does this actually look like in practice? Well, let's say you're following a 4% withdrawal rule. Maybe 1.5% of that comes naturally from all the dividends and interest your portfolio throws off. You then just generate the other 2.5% by strategically selling some shares as you rebalance. This way, you get the income you need, you stay in control, and you stay beautifully diversified. It really is the best of both worlds. Ultimately, this whole thing boils down to one final, really important question you should ask yourself. Is your financial plan built to serve your life with all its changing needs and unexpected goals? Or is it rigidly built around the dividend payout schedule of some corporation that you don't control? Remember, the goal isn't just income. It's a sustainable, flexible cash flow that allows you to live the life you want. And dividends are a powerful tool to help you get there, but they are just one tool. They are not the entire plan.